Hi everyone, it's Katya and welcome to my channel. Today we are talking about refinancing of your mortgage. So let's get started. First of all, refinancing of your mortgage is a process of replacement of your current mortgage with a new mortgage, and the funds that you are getting on from your new mortgage will be used to cover and pay off your existing mortgage. Just like in acquiring your purchase mortgage, you will need to provide your lender with some supporting documentation. First of all, if you are W-2 employee, you will have to provide your lender with 2 years of your tax returns, 2 most recent pay stubs, 2 most recent bank statements, your ID. Now, if you are self-employed, if you are a 1099 employee, if then you are in business for more than 5 years in the same field, you will only have to provide your lender with a 1 year of tax returns. And the rest of the information will be the same. 2 months of bank statements, 2 most recent pay stubs if you're receiving any, and your ID. Additionally, your FICO score will have to be at least 620. Finally, we would ask, as a lender, we would ask for some information about your mortgage. Usually we would ask of what is your interest rate at the moment, how many years have you been paying off your mortgage, and what is your payoff balance. You can simply provide your lender with your mortgage statement, and your mortgage statement will have all of that information listed. That is important to provide your lender with all of this information so that your lender can help you with the best option that fits your financial situation the best. Now, just like in traditional purchase mortgages, refinancing of your current mortgage will involve a closing costs. Closing costs would be something like lender fees, credit report fee, attorney fee, a new appraisal, title insurance, title report, and title search. And additionally, if you do have an escrow account, you will have to set up a new escrow account with the prepaids. And the funds from your previous escrow account will be sent back to you in a form of check or ACH payment. It really depends on a escrow company. Prepaids usually include homeowners insurance, property taxes, and mortgage insurance if there is any in place. Now let's talk about reasons why would you want to refinance your mortgage. And as an example, I would want to use my own mortgage that I refinanced in January of 2021 when I was able to lower my interest rate from 4% to 2.5%. Usually to calculate the refinance estimate, I usually go to realtor.com where I'm able to enter all of the information and receive my estimate and receive the best part of this calculator is break even point. So I got my property in Atlanta, Georgia. My loan amount was $172,000. My loan term was 30 years with an interest rate of 4.05%. I got it in June of 2018. And my current balance is $154,000. I'm not taking any funds out, so I'm leaving that blank. Now, I do have my new loan for 30 years with an interest rate of 2.5%. Now you can see that I am saving $218 every single month. Now, it did cost me, my actual cost was around $3,200. This is an estimated cost because every single refinance cost is different. And the best part here that it shows you the break-even point. So how long it would take for you to make this $3,600 back. In this case, it shows me a year and a half, which is great because potentially I can invest $3,600 and that is a huge saving for me, and I can bring this saving back within a year and a half. Now, It also shows how much your payment was reduced, which is my case was around $300, and my payment went from $1,300 to $1,000. Sometimes clients do ask, well, if I have a fixed rate mortgage, why does my monthly payment goes up? It's not because of your fixed rate, it's because of your either insurance costs or your property taxes, because as we know, the property taxes go up on a monthly basis. This calculator only calculates principal and interest amount with a interest rate applied to it. So please keep that in mind. So why refinancing your mortgage? First of all, as you can see from my own experience, from my own example, you can significantly lower your interest rate, and that is by far the most popular reason for the refinancing, because that is potentially saving you a lot of funds. And as you can see in my own example, I'm saving nearly $300 a month. Second popular reason to refinance is switching a rate type. For example, if you have a adjustable rate mortgage, you can refinance to switch to a fixed rate mortgage. And as we all know, a fixed rate mortgage is a more stable and secured option. Third popular reason to refinance is to cancel your mortgage insurance. For example, if you have an FHA loan with the mortgage insurance for the life of the loan, you can refinance for a conventional loan as long as your credit score is at least 620 and you are putting at least 20%, or you already have at least 20% of equity in your home. In that case, you can refinance and save a lot of funds in a mortgage insurance that you will be not paying. Fourth reason to refinance is paying off your mortgage loan faster. For example, if you have a 30-year fixed loan, you can refinance to, let's say, a 15-year fixed loan. Your payment will go up because your loan term is shorter, but that will give you an opportunity to pay off your loan faster. That majority of the times works for a small loan amounts. For example, if you have $100,000 of a loan amount left, you can refinance for a 15-year mortgage instead of a 30-year. That way you can pay off your mortgage twice as fast. Additionally, by refinancing, let's say if you need some funds, if you have built up some equity in your home and you need some additional funds for, let's say, your kids' college tuition, to perform some improvement or remodeling on your property, you can do a cash out refinance and use those funds for any needs that you have. Remember, when you are doing the cash out refinance, you are not paying any taxes on the funds that you have pulled from the equity in your home. Let me give you a little bit more details in regards to when you're refinancing an FHA loan versus a conventional loan. So when refinancing a FHA loan, it works a little different than a conventional loan. First of all, for an FHA refinancing, a refinancing process called a streamlined refinance. In this case, you are refinancing from FHA loan to an FHA loan. In this case, generally the lenders do not require any documentation from you besides your updated FICO score and employment verification letter. You do not need an appraisal, you do not need any of the paperwork, you do not need any of the income verification. All you have to have is your FICO and your employment verification, and the process takes around maybe 2 to 3 weeks. It's relatively fast. Your interest will be reduced and your payment will be reduced as well. Now, remember, refinancing from an FHA to an FHA does not avoid mortgage insurance. You cannot cancel a mortgage insurance if you have an FHA loan. Now, let's talk about refinancing from an FHA to conventional. First of all, your FICO score will have to be at least 620. With a conventional loans, you have to put 3% down payment. When refinancing, you are not obligated to put any down payment unless it's required by your lender, and it really depends on the case-to-case situation. Additionally, if you are refinancing from an FHA to a conventional and you would like to get rid of your mortgage insurance, you can put additional funds down for you to have at least 20% of equity in your home so you can get rid of a mortgage insurance. But if you would like to keep your mortgage as is and simply refinance from an FHA to conventional, you have to request a cancellation of your mortgage insurance in a conventional loan. Otherwise, if you do not request it yourself, your lender would automatically cancel it when your equity would reach 22%. Finally, when you're refinancing a conventional loan into another conventional loan, majority of the times that happens simply because clients would want to have a lower interest rate. You will still have to provide your lender with all of the required paperwork, and your FICO score would have to be at least 620. Additionally, if you would like to put some funds down to get rid of your mortgage insurance, you are absolutely welcome to do so. That would help you in the long run to save more funds on your mortgage insurance and allocate them to a different project. So to sum up, refinancing of your mortgage is a great option to save potentially a lot of funds and reduce your housing expense. Additionally, if you would like to pull some equity out for remodeling, for your kids' tuition, you can absolutely do so as long as you have a good amount of equity built up in your home. Finally, you can refinance as many times as you would like to. Make sure to consult with your lender and find the best option for you. Thank you so much for taking time to watch this video. If this information was useful for you, please click thumbs up and subscribe button so you will be notified next time my video comes up, and now would know that this information was useful for you. Thanks again for your time, and you folks have a great one.